A really important concept for any business is the total length of time in between receiving money in from its customers, from the sale of its products or services, and having to pay out the costs it's incurred in the provision of those products or services. This cycle is known as the operating cycle or the cash conversion cycle. And it's really important because the more quickly a business can generate cash, the more it can do with that cash, whether that's paying dividends to shareholders, for example, or investing that money back into the business to improve operating efficiency. The better a business is at converting its current assets into cash, the more likely it is to be able to succeed. So we're going to look now at the formula for the operating cycle for a retail business. And to do that, let's make a one-off purchase of inventory on day one of £100,000. Note that our payables days are 5, so we're not going to pay for that inventory until 5 days later. So we've made the purchase and we can see that we've got an inventory balance, and we note that 5 days later, so on day 6, we're going to pay for it. And as we can see, we've now paid for the inventory. So we bought it on day 1 and we paid for it 5 days later on day 6. So we're going to now sell that inventory on day 11. So 10 days after buying it, we're going to sell it. So as you can see, we've now sold that inventory and we've now owed money by customers, and they're going to pay that, in this case, 15 days later. So 15 days later, on day 26, they paid. So the cycle was day 26 was when we got the money in, and the money went out on day 6. So the total length of time is 20 days. And that's made up of 15 days of receivables days. We kept our inventory for 10 days. And we also have to take off the 5 days before we had to pay the supplier. So it's 15 plus 10 minus 5, giving us a 20-day cash conversion cycle.